The Black Numbers Law Console. How the Machine Works. Part 1. Building Your Wealth. Let me start with a hard truth. Most people do not lose money because they picked the wrong fund. They lose money because they acted at the wrong moment. And they acted with their emotions, not with a plan. This console is built to remove the emotion. Everything I am about to explain is really one simple idea, repeated 5 times. Decide today, calmly, what you will do when the market does something scary, or something exciting. Write it down. Then simply follow it. That is the whole idea. First, the 2 buckets. All your money sits in one of 2 places, and they do 2 very different jobs. The first is the core. This is small cap, mid cap, and dividend yield. This is your engine. It grows quietly for many years. You do not touch it. It is not clever. It is not active. And that is exactly the point. The second is the strategic bucket. This is balanced advantage, floating rate debt, aggressive hybrid, and gold. This is your ready money. It looks slow. For long periods, it seems to do very little. But it is not there to grow. It is there to be ready. So here is the one line to remember. The core is what you own. The strategic is what you use. Most people only have a core. So when the market finally gives them a big chance to buy, they have no money left to buy with. They are fully invested and tired at the exact moment they should be buying. So why have triggers at all? Because of a simple truth about buying low. Everyone agrees you should buy when prices fall. But almost nobody does it. Because in that moment, buying feels wrong. The news is scary. Your neighbor is selling everything. And the thing you want to buy is down 20% and looks like it will fall more. So the decision must be made earlier. When you are calm. When nothing is at risk. When you can think clearly. A trigger is simply a promise you make now to protect yourself later. And the numbers are not random. A 10% fall. A 20% fall. A 25% fall. Big enough to be a real opportunity. But not so rare that they never happen. Now, the 5 triggers. Trigger 1. Midcap falls 10%. When the midcap index falls 10% from its recent high, your floating rate debt money moves into a midcap index fund. When midcap recovers to its old high, the profit moves back. Why 10%? Because for midcaps, a 10% fall is common. It happens often. So this is your everyday worker. It acts most often and does the quiet regular job of buying small dips. Trigger 2. Small cap falls 20%. When the small cap index falls 20%, your balanced advantage money moves into a small cap index fund. When small cap recovers, the profit moves back. Why 20% here and only 10 for midcap? Because small caps fall harder and more often. For small caps, a 10% fall is normal. 20% means something real has happened. Trigger 3 is gold. And gold is very different from all the other triggers. It has its own full story. So we will explain gold separately next. Trigger 4. The market doubles. When the Nifty 50 doubles from a starting level, we move a small part out of small cap and mid cap into value and contra funds. This is the only trigger that acts on good news. And that is why it is the hardest one to follow. When the market has doubled, nobody wants to sell. Everyone feels like a genius. But that is exactly the moment when risk is highest and hardest to see. Notice, we only move a small part. We are not calling the top. We are just making sure we are not fully exposed after such a big rise. We reduce a little. We do not exit. Trigger 5. A sector falls 25%. When any cyclical sector falls 25% from its peak, we move money into that sector, using a floating rate debt switch. Cyclical sectors go up and down in cycles. That is their nature. When they fall 25%, they are not dying. They are simply doing what cyclical sectors do. The common mistake is to treat a normal cyclical fall as a permanent failure. We do the opposite. We buy it. So notice one thing about all 5 triggers. Every one of them is a rule about when to buy. This whole first part of the console is a buying machine. It is built to turn your fear and market falls into more units for you.
Now back to gold. This is the part worth slowing down for. Gold does nothing for years, and then it does everything. Gold is not like a business. It does not earn. It has no profit, no income. It just sits there. And its price history shows this clearly. Long, flat, boring years, and then sudden, sharp jumps that come all at once. Base, breakout, run, peak, base again. The flat periods are long years, sometimes decades. The jumps are short and powerful. This means almost all of gold's gain comes in a very small part of its life. If you are not already holding gold when the jump starts, you miss most of it. So here is the key question. Which all-time high? Not every new high. We mean the previous cycle's high. The high that stood for years, while everyone had given up on gold. Look at the history. Gold reached a peak in 1980. That peak then stood for 27 years. 27 years of gold being a dead investment that nobody wanted. Then, around 2007, gold finally crossed it. The trigger fires. Then it peaked again in 2011 and stood for 9 more years, falling 40% along the way. In 2020, it crossed that peak too. The trigger fires again. Only twice in 45 years. That is the whole point. This is not a plan that jumps at every small rise. It acts only when a very old, very strong peak is finally broken. But why buy an all-time high? Is that not the worst time to buy? Every instinct says buy low. But gold does not behave like a share. When gold stays flat for years, every person who bought at the old peak is simply waiting to get their money back. So they sell whenever the price rises. That selling acts like a ceiling. It keeps pushing the price back down. But when gold finally crosses its all-time high, all those old sellers are gone. Everyone holding gold is now in profit. The ceiling is gone. And because gold earns nothing, there's no way to call it expensive. The old high is not a value. It is just a level. Now, how does the money actually go in? Not all at once, because a breakout can be false. Let me tell you what happened in real life. In August 2020, gold crossed the 2011 peak. It looked like the run had started, but then gold fell back below that level, and it stayed flat, going nowhere, for 3 more years. Now imagine you had put all your money in on that first day. You would have been stuck, watching nothing happen, for 3 long years. This is exactly the mistake we want to avoid. So instead, we go in slowly, in 3 steps. Each step needs stronger proof. Step 1. On the first daily close above the breakout level, the floating rate debt money moves to gold. This money goes first, because it is the safest to be wrong with. Step 2. On the first monthly close above the level, the balanced advantage moves. A monthly close is important. It means gold stayed above that level for a full month. That is the price truly accepting the level, not just touching it for 1 day. Step 3. On the second monthly close, the second hybrid moves. 2 monthly closes means is a real trend, not a one-time jump. And one more point. We watch the gold price in US dollars, because the dollar is where gold's real cycle happens. And how much money goes in? That depends on your age, because to earn the full gain, you may have to wait many years, maybe close to 5 years. That is an easy wait when you are 40. It is very hard when you are 58. So we match the size of the bet to the time you have. If you are below 50, half of the strategic bucket moves to gold. If you are above 50, only 25% moves. And this is a strict rule. Nobody ever puts everything in. Even the youngest person moves only half. Why? Because the strategic fund has another role to play, which is to cushion the market dips. So, it means half of the strategic bucket is always kept aside. So the other rules never run out of money to use. A slow gold decade can hurt the plan a little. It can never break it. And why wait for such a big 200% gain? Why not take a small profit and leave? Because you are not trading gold. You are waiting for the full cycle. If gold gives you years of nothing, then everything at the end, then taking a small profit defeats the whole purpose. If you leave too early, You suffered all the boring years and missed the reward. So we wait for the full move. We sat through the long wait. We do not get off at the first stop. Finally, once gold achieves a 200% rally, you conclude the cycle by switching back into your strategic allocations. So, step back and see something about all 5 triggers. Every single one is a rule about when to buy. The whole console in this first part is a buying machine. It is built to turn fear and market falls into more units for you. But there is a day when this completely changes. The day you retire. From that day, a market fall is no longer a chance to buy. It becomes a danger. Because now you are selling units to live, not buying them. The same market that made you rich over 30 years can hurt you badly in 3. And that is why we built the second half of the plan, the 5 gears. The first part asks, how do I turn market falls into more units? The second part asks the opposite. How do I take my income safely without being forced to sell at a bad time? Same money, same market, opposite thinking. That is part 2, the accumulation engine. We will cover it next.